Hello, everyone. We are here at the top of the hour, so I am going to go ahead and get started. We are going to be talking today about decoding your 401k. And why I feel like that's important is oftentimes when I'm working with people, especially folks that don't have a ton of experience in investing, a lot of times your investment menu can be overwhelming or you don't really know where to start. And so our purpose today is really to give you the tools that you need to have a better understanding when you look at that investment lineup. I don't expect anybody on this call today to be an investment expert after the call. Really, my goal here is to make sure that you know exactly what's going on under the hood from an investment perspective and allow you to feel more comfortable and confident when it comes to making investment decisions within your 401k. I feel that the 401k is the single greatest tool that you have as an employee within a business to build wealth for yourself and to do so in a way that you feel comfortable and confident is what's going to set you apart from anybody else in the world when it comes to establishing a financial future that you are confident in. So that's a little bit of background on why we're here today. Again, our presentation this morning is Decoding Your 401k, a guide to smarter investing. A couple of housekeeping items we have before jumping in. This is being recorded. So know that if you miss the first couple of minutes, you're just getting signed on now, or you have to step away for a phone call or somebody pops in your office, you will get a copy of the recording here today. So you can always come back and revisit the conversation that we're having. Also, the Q&A box is open. So if you have questions as we go along through this conversation, this is meant to be interactive. This is meant for you. So please take the time, ask questions, and we want to make sure that you walk away here getting the most out of our time today. So let's jump in. What's inside your 401k? If you've been investing in a 401k before, this may be a bit basic. If you've never contributed and are unsure of what is really going on underneath the hood in the 401k, you'll take a lot away from this. So in its simplest form, when you are looking at the investments in your 401k, you have stocks and bonds, and those factor into the mutual funds that you're investing in. Stocks are going to be owning a piece of a company. Bonds, you're going to lend money to an institution or a local, state, or federal government, and those funds are taking a diversified approach to your stock, bond, or a combination of the two's portfolio. Really, inside every 401k, you're going to be investing in mutual funds. I'm going to use the term mutual funds. There's another investment option that's called an ETF or an exchange traded fund or an index fund that are also components of your fund lineup. But for the purposes of our conversation today, mutual fund is going to be the catch-all term that I'm going to use when describing the investments that are actually in your 401k that you can utilize today. So stocks. This is the hottest topic when it comes to investing, is investing in the stock market, right? How's the market doing? What's the S&P 500? What's the Dow Jones? What's the NASDAQ doing? All of these are questions that are based around stocks. So when you're owning a stock, you're actually owning a piece of the actual company. So let's take a very simplistic example here. Say you own a stock in Amazon. You are actually an owner of the company of Amazon, and you share in the success and also the failure of that business to meet or exceed expectations. With that, you're going to be on the higher end of the risk profile. Now, we'll talk about the risk and reward components, especially more so in the deep dive around mutual funds. But if you're comparing cash bonds and stocks are going to have the most volatility, right? They're going to have the highest highs, the lowest lows. You're going to be able to grow your account more in stocks than you would in bonds typically. But when times are bad, you're also going to feel it more, right? That's the trade-off when it comes to investing in the market. And so going back to that Amazon example, let's say Amazon not only meets but exceeds expectations from an earnings perspective, right? How much money that company is making, how much revenue is growing year over year. If you're meeting and exceeding those expectations, then that stock is going to grow. You, as a owner of that company, is going to make money. On the flip side of that, let's say Amazon misses expectations. Here's a very challenging thing to understand is that stocks are not just the result of today's financial picture of a company. It's also the future financial outlook that the company is providing and that the public believes. So if Amazon comes out and has a quarter that they had a challenging results, and it appears that this is going to be something that's not a one quarter issue, but a multi-year struggle that they're going to have to work through, you're going to see a decline in that stock price. So you're going to lose money. So in both examples, let's say the positive quarter that we saw, you had $100 and the share price rises. Let's say your share price goes from $100 to $110. You've got $10 more in your pocket simply by the performance of Amazon. So what that's showing is, hey, your money is working for you in an organization that you have no interest or control over, right? Your money is doing the work for you. On the flip side of that, let's say we miss expectations and we see some challenging growth ahead of us. That stock could fall from $100 to $90. Now, if you don't sell, on paper, you have a loss, but you still own that one share of stock. So that's the important thing to understand when it comes to volatility, right? You may see wider swings, but unless that company is going bankrupt or you're selling it in that exact moment, you're only losing money on paper. In its most simplistic form, stock is ownership in a company. You're taking on more risks than you would in bonds or cash, but you have a higher potential reward. The last component of this is just a simple analogy that maybe hits closer to home than a large organization like Amazon. Local restaurant, right? Think of your favorite pizza spot down the road. You buy a small share of that restaurant, right? And let's say that you have some publicity that drives a ton of business to your pizza joint. You end up making a ton of money. Part of your share is going to go up and up in that organization. Now, let's say COVID hits and you're not really sure how to pivot in a environment where you can't have people in the restaurant and that the income of the restaurant goes down, your ownership stake in that company goes down as well. So that's where, if you're thinking about it more on a local level, that's what a stock is in its reality. It's that ownership piece of an organization. Now, as you dive deeper into the stock component of your investments, especially within your 401k, you're going to have different aspects of stocks. When you're looking at an investment lineup in your 401k, you're going to see large cap stocks, you're going to see mid cap stocks, and you're going to see small cap stocks. CAP stands for market capitalization, or simply the total dollar value of the organization. What that means is, in its simplest form, it's the company size, right? So an Apple or an Amazon falls into that large market capitalization bucket. Really, any company that you're interacting with on a day-to-day basis is a large cap company, right? If you're using an iPhone, you're interacting with a large cap company. If you have a Dell computer, that's a large cap company. So these are large established organizations that typically in today's world have a global reach to their sales, to their marketing, to everything that they do. So they're incredibly diversified businesses that are not necessarily riding on one supplier or one distributor for their success. Now, on the flip side, let's talk about small caps. So small cap companies are really smaller entities, right? Maybe they are very regional in the way that they do business, or it's a brand new idea that hasn't necessarily caught on. So those are going to be the type of companies that fall into the small cap or small market capitalization standpoint. So think about large cap companies like Apple are generating billions of dollars of revenue every single quarter. Incredible size and scale. Small cap companies, they're still, compared to local businesses, are going to be larger entities, but they're going to be earning revenues in the millions, not the billions of dollars. And so when it comes to that, your large cap companies, they'll be more stable, less wild swings from an investment perspective, where small cap is going to be even more aggressive. They're going to have higher growth potential, but also higher loss potential. And so when you're thinking about your investments and you're thinking about large cap and small cap, and then mid cap falls right in the middle there, where do you want to see success? Large cap companies are not going to be as wild in share price swinging, so you're going to have less volatility, still with a higher growth potential than bonds or cash. Small cap will be very volatile. So some years will be great, some years will be really hard. Over the last 10 years, quite frankly, small cap companies have really struggled. The reason being is with money being so easy to access, especially for these large organizations as they grow and grow, it becomes harder for these smaller entities to compete with the Apples and the Amazons of the world. Though sometimes if you're looking at, let's say, 10-year or since inception numbers in your investment review process, your growth potential in small caps will be greater. But if you look at more relative performance, small caps have been underperforming typically large cap companies with more volatility. So it's an important component to understand as you're looking at your investment menu, trying to decide the right selection for you. Do I want large cap? Do I want small cap? We don't want you to only be making investment decisions based on that since inception number. Important criteria, sure, but the only criteria you should be looking at, not at all. So that's really where the companies land in terms of size and what that large cap, mid cap, small cap means. Now, bonds. Bonds, I'll be honest with you, are probably a more boring conversation than stocks, but they're an important component when it comes to building a portfolio. Why is that? Typically, it is what's called a non-correlated asset. It doesn't move in lockstep with stocks. So it gives you some diversification in your portfolio build out, especially if you are later in your career. Maybe you're thinking about transitioning to retirement or something along those lines where you don't want to see a huge drop in your portfolio over the next 6 to 12 months, right? Bonds can help be a buffer in your portfolio growth and downside risk. So what is a bond? I like this chart because it lays it out in its simplest form. A company, say Amazon, or a government, say the federal government, wants to borrow money for, let's say, a project, and it's going to be a 12-month project. You lend them $1,000 and they are going to pay you 5% to use that $1,000 to work on that project for the next 12 months. What will happen typically at about that 6-month mark, you'll get $50, some interest based on the specifics of the bond that you are purchasing. And then after the 12 months, you get a full of what we call return of capital, right? That full $1,000 that you lent to the company or the government is going to be paid back to you in full. So you as a lender earn that $50 to not do anything with your $1,000 over that 12 months. You're letting the company use that money for a period of time. Let's say they were going out to pick up dinner for their children. They were $20 short. You had $20 in your back pocket. You said, here you go. Here's $20. You don't see them for a month. And when you bump into each other, they give you $22 in exchange, right? Hey, thanks for the $20. I really appreciate you being there when I needed you. And I'm going to give you $2 additional for the trouble. So that is meant to be an example of how a bond functions in its structural component, right? And how it actually functions as an investment option. We've talked about stocks, we've talked about bonds. Mutual funds are going to be a basket of those entities. So mutual funds can have all stocks, all bonds, maybe some real estate, sometimes all real estate, or a mixture of the three. The benefit for you as an employee that contributes to a 401k is that these mutual funds are baskets of investments managed by professional money managers. So you don't have to go in and say, hey, I know I want to invest in stocks, but I need to find the 50 best stocks for me. And I need to make sure that I'm allocating appropriately as the value of these stocks change every single month. You have a day job. You have a lot going on outside of work to be putting in the time and money and effort that it takes to be a professional money manager. So when you're utilizing mutual funds, what you are taking advantage of is the mutual fund manager and the team underneath them, which are making those investment decisions for you. With all that being said, you also have the bond component, the and real estate component as well. So you get a little flavor for everything. And when you're looking at your investment portfolio within your 401k, you'll see a bunch of different options: large cap, mid cap, small cap. These are all mutual funds in the stock market component. You'll have balanced funds, which will have a mix of stocks, bonds, and real estate. You'll have bond funds as well, and you'll have target date funds. We're going to dive into a little bit of that further. So again, if you're thinking about a mutual fund, here's the workflow in reality. You have a fund manager who is the expert. They're making the decisions in the portfolio. They're picking the investments that they feel are going to give you the best chance for growth. It's not just your dollars, right? If you're getting started in your 401k and you contribute $150 for the first pay period, it's not just $150 going into different investment options. You're getting the buying power of the entire fund, whether you have $150 in there or $1 million in there. That gives you benefits as an investor over time. It's going to be spread across multiple investments. So you're not simply relying on the success of Amazon, right? That's a very concentrated play. You're thinking of larger themes, whether that's particular market capitalization, whether that's making sure that you've got a well-diversified portfolio, or you're looking for something more risk averse like a bond portfolio. And then you as an investor share in the returns of that investment. So again, think about, instead of buying 50 stocks on your own, having to track all of that, having to manage it, it's going to take that work off of your plate and ensure that you are well diversified and set up for success within your investment exposure. So from mutual funds, I want to spend some time on the target date fund. And if you're like we'll say 85% of employees today are invested in just this, a target date fund. So if you've looked at your portfolio, if you get a statement, hey, I'm invested in this stock or this mutual fund, and I'm not sure what it is, and it's got this number at the end of it, what the heck is that? You're not alone. So this is most typically a default investment option, right? You weren't really sure what investment to choose when you were getting started. You knew you needed to get started, and you wanted to make sure that you were invested as those payroll deductions began. You're going to be invested in this target date fund. And the actual underlying resources that are built into this target date fund are fantastic for somebody that doesn't want to be managing a portfolio ongoing. If you look at these dates, 2030, 2040, 2055, what this means for you if you're in one of these funds is that number is the closest date to which you turn 65. What's going to happen is this fund in and of itself is meant to be a single holding, okay? And that single holding is going to have mutual funds that we talked about underneath it. So you'll have stock mutual funds, bond mutual funds, and the various sorts real estate mutual funds that will be aligned to the point you are in your career. You've got 10 funds and they're allocated to growth and large cap, mid cap, small cap, bonds, and real estate. The allocation in and of itself for how much money is into each one of those funds will be different if you're 20 versus if you're 60. So to give you a visual representation of what that means, these target date funds are a dynamic investment option. What I mean by that is you as a younger investor, you're going to have more stock allocation in your portfolio because you have more time to let that money grow. You don't necessarily have to worry about volatility as much as your portfolio is building up. We want you to take advantage of the power that the market brings. As you start progressing in your career and you get closer to retirement, your lens changes, right? A 10% drop in the market feels a lot different to somebody that's been saving for 30 years than someone that's been saving for 3 months. So the portfolio itself is going to strategically get more conservative for you. So if you look here at this example, you've got somebody that's much younger, isn't looking to turn 65 until 2055, 90% stocks, 10% bonds. Somebody in 2040, you're looking at a more balanced approach. You have that bond allocation that's built out a little bit, so you're a bit more stable when the markets get volatile. And then for somebody that retires, you're going to have a much more conservative approach, right? So you're going to have less in stocks, more in bonds. So you're really protecting all that work that went into saving for retirement, right? So you don't open your portfolio one day and go, gosh, what the heck happened? Can I retire? I thought I was going to retire next year. And that's what these funds are meant to do, right? It's meant for you to say, I'm going to take my hands off the wheel from the investment perspective, and I'm going to allow these funds to work for me. You're looking at the investment options within your portfolio. Here's a quick decoder, right? Growth, so large cap growth, mid cap growth, small cap growth. You're going to have higher risk companies. It's certainly a stock focused portfolio. And a lot of times those with longer time horizons benefit by being in these growth focused portfolios. Income will be bonds, steadier returns, less ups and downs of the market, right? You're going to earn that interest without having to worry about all of the volatility that stocks bring along with it. A balanced approach, great for those individuals that don't like risk or are getting closer to retirement and considering thinking, hey, I'm 5 years out. I want to grow my portfolio still, but I don't necessarily want to feel the volatility of the stock market every single day. That's a great option for you. Any investment that has a date associated with it, that's going to be your target date fund. So think 2045, 2055, wherever you are in your career, it's going to be allocated for you specifically. And then one thing we mentioned earlier, that index fund, right? That's one of the most popular investment options for those that want to be invested all in stocks, but don't necessarily want that expense that comes along with a professional money manager. So the most popular index fund out there, which would be the S&P 500 index. That's really just tracking what's called the S&P 500 index in general. You're going to have the 500 largest companies in the US. If that index goes up, your portfolio goes up. If it goes down, your portfolio goes down. There are great options within your 401k. My job is to make sure that the investment portfolio that is working incredibly well for you and your organization. So we're making sure that the large cap growth fund continues to be a top performer. Your mid cap growth fund continues to match those goals that we have for that particular class. So bottom line, as a 401k investor, it's very easy to overcomplicate this process. And I like to simplify things down to 3 habits to master. If you're enrolled or you are automatically enrolled, you're contributing consistently. Keep doing it. Good times, bad times. Just set a contribution rate that works for you and maybe revisit it once or twice a year to make sure that you're contributing the right amount for your budget. Then when it comes to fund selection, find something that fits your goals and what you're trying to achieve. Your goals may look different than somebody else down the road. Maybe you are taking on growth risk. You want to earn as much money as possible. Maybe other folks want to have a more steady approach to the way that they invest. Find what works for you and stick with it. And it's going to allow the power of the market to work in your favor over time. And then lastly, don't overthink it. This is a situation that you can end up being your own worst enemy, right? If you stick with this process that we say and you let it work for you, you will be amazed at the success that you will have saving as a 401k investor. In my email, you'll have a link to the calendar, to my calendar. So if you have questions about the presentation or you're not sure how your investments are aligned to your goals and expectations, schedule time with me there. And then on top of that, know that we're going to continue to put out resources for you on the investment front. We've got the YouTube channel that's gone live. This will be posted to the YouTube channel as well, where we're posting information for 401k investors like yourself to help you make better decisions. And we've rolled out our 27T charted newsletter as well. So you're getting real-time data about what's happening in the stock market and how it impacts your portfolio. And then if you want to talk specifics as an employee who works with us as a firm, you get one-on-one time with me whenever is convenient for you. So save my calendar link. It's evergreen. You can always go in there and schedule one-on-one time when the need is most important. So I want to thank everybody for being here today. I want you to feel like you've got the tools and resources to be a successful 401k investor. Now, that is all that I have for the prepared remarks today. I am going to open this up to questions for folks that are on the call. So the Q&A box is open. If you have questions, please go ahead and put those in. The first question that came in is, where is the calendar information? So I'm going to put that directly into the chat. So you've got that. It will also be included in the follow-up email as well. So when we log off, if you forgot to copy and paste it, or you close out the window before you actually schedule something, no, it will be coming in that email as well. My plan has a lot of options. Is there such thing as picking too many funds? Great starting question here. If you're thinking about the ownership of a mutual fund, you're going to have individual stocks underneath each company. And so if you have too many investment options in your portfolio, you'll what's called over diversify. You're going to have just as much risk without as much upside. So that's where, if you have a target date fund that you're utilizing, it's meant to be a single investment option, right? You don't want to have a target date fund and 4 other investment options. But you also don't want to put a little bit into everything in the portfolio. So if you're building your own portfolio today, anywhere from 1 to 4 options is probably the sweet spot. And you don't really want to go over and above that, because you'll be overcompensating for the investment options that you're utilizing in each individual fund. That's where, when we're having the investment conversations, it's going to align with what are your goals, and then let's find the right investments for you. All right. Next up, what if I don't plan to retire exactly in the year of my target date fund? I changed the question up a little bit, but what that question is asking specifically is, so, hey, you've got a 2040 fund, and maybe you're going to keep working till 2045. Maybe you want to retire early, say 2035. There's a couple of things you can do. One is you can leave it as is, right? That fund is meant to be a single holding. And just know that, hey, you'll be a little bit more conservative if you're working longer in the years leading up, or you may be a little more aggressive in the years leading up if you're retiring early, but you may be comfortable with that timeline. Or you can adjust that to match where you're at, right? Hey, I want to retire in 2035. You can change your target date allocation from 2045 to 2035. Or on the flip side, you want to retire in 2055 and you want to be more risk on, if you will, then you can adjust back to 2055. Next question we have, how can I tell when it is time to rebalance my money? That's a great question. And in true financial advisor fashion, I'm going to say it depends. If you're like me and you like a process, I would say no less than twice a year, you want to be looking at your portfolio. And let's say you've established a 60-20-20 allocation, right? Maybe you've got 60% in large cap growth, 20% in fixed income, and 20% in mid cap growth. What you'd want to do is what happens over time is sometimes large caps are going to outperform mid caps, are going to outperform bonds. And so you'll have a higher allocation in large cap than the other entities. So you can set up the allocation to adjust semi-annually or every 6 months. Or what you can do is say, I'm going to hop in there every June and January, or every July and every January. I'm going to see where we're at. If it's 2%, maybe I let it continue on in the way that we're set up. And if it's 10%, then maybe I dial it back, right? If there's 10% difference in that allocation of which I originally set up. So again, minimum, I'd say annually, maximum, I'd say quarterly. Find the right mix for you in that time frame. So we want to make sure that it's something that you can actually adhere to, not just in 2026, but for the next 1, 3, 5, 10 years of your career. So you're being consistent in the approach that you take. Do my fund options show me whether they're large cap or small cap? Yes. So when you are looking at the investment page in your 401k plan profile, so whether you're using Fidelity, Empower, John Hancock, Principal, Voya, any of the different platforms that we partner with and utilize for the 401k, there's an investment tab. In that investment tab, you'll see each investment option based on those criteria. So you have large cap, mid cap, small cap, bonds, oftentimes short-term, intermediate, long-term bonds, which is just how long you're lending out the money. And so you'll be able to actually see the specific components of your investment option there. But in the event we don't have anybody else answer anything, we're going to wrap things up here. Again, I wanted to get you time back in your day. It's hard to carve out a full hour in today's world to talk just about 401k investing. So I do appreciate everybody that's on the call today, that's asking questions, that's getting involved in your 401k. This is a very exciting time. I think that the 401k, again, back to my original opening comment, as an employee of a company, this is your single greatest tool to create wealth for yourself. So take the time to understand it, take the time to utilize the resources that your company make available to you by working with 27T Financial and getting that personalized approach to your investments. Let's see here. I did see one last question come in here. I have the app set up. Is there a website I can go to and see my 401k on my desktop? Yes. So every 401k platform has their own specific website that's associated with the app. So if you want to send me an email, I'll put my email in the chat as well in the event you don't have it. Send me an email. I can send you the exact website of which to access your account. You should be able to use the username and password that you use to set up your information on the app. But in the event you run into any errors, we'll lean on our participant or employee services team to help you troubleshoot any issues you might have getting onto the desktop. So everyone should be able to have access to the information stated. Again, we will be sending out a recording here in the next week or so of this conversation. It'll include a link to my calendar, and we just want to be present in your financial life. Questions, comments, concerns, that's what you have access to as somebody that works with a 27T Financial 401k plan. I want to thank everybody for the call, for the time on this call today. Thank you for being engaged, for asking questions. Please join in on the YouTube channel. We'll also be sending invitations out for the future education events that we have coming up. So stay tuned. Thank you all. Have a great rest of the day, and I'll talk to you soon.